All right, greetings, friends. Welcome to Market Depth Podcast. My name is Weston Nakamura from Blockworks Macro in Tokyo. And now that we're about a month into this new venture of this podcast, we have a very special guest joining us today for our very first interview of Market Depth, Mr. Taka Kato, formerly head of sales and trading at Bitflyer. How are you, sir?
Good. Thanks for having me, Weston.
So until now, it's basically just been me talking to myself and commentary out of Asia, markets, macro mostly, obviously. This is the first time I'm talking to another human being, and I'm very honored that it's you. So thank you so much for doing this. Up until very recently, you were head of sales and trading at Bitflyer, which is the largest crypto exchange in Japan and one of the largest in the world. But prior to that, you did have a very long and extensive career in TradFi in macro. And we had a little bit of not overlap, but we did. We both had stints at the Goldman Tokyo execution trading desk and all that too. So if you want to just kind of go through your background, just to let the audience know who you are.
Sure. So my name is Taka. I started my career at Goldman. So I was there for 13 years and kind of did everything from hedge fund sales to execution, as you mentioned, where you learn a lot about the markets themselves and staring at them day in and day out. But also did a stint at Morgan Stanley and Citigroup, basically in the areas of equity derivatives and hedge fund sales. So that's been the main part of my TradFi career. And then more recently, Bitflyer, I wanted to learn about crypto in pretty in depth. So I thought the only way to do it was to really jump in there and deal with it and trade it day in and day out. So I did that for 2 years, and really enjoyed it and learned a lot.
And what made you move? What interested you? I suppose away from traditional finance and into crypto to make that jump.
It started with really a set of papers that were released in September, October of 2020. Basically, everyone from the BIS, the OECD, FATF, they all basically wrote a bunch of papers talking about crypto and really central bank digital currency. And that really got me thinking that this was going to be for real. They were viewing it that way, and they were creating the framework for the monetary system of the future. And so I thought I'd go check it out.
Right, but you obviously in 2020, Bitcoin was not new to you. You were very aware of it from what, white paper days, Satoshi white paper days or so, or shortly thereafter. But I guess you were kind of hesitant, and then so that BIS paper is what I guess was a catalyst for you that this is going to become huge.
Yes, and I think by then the regulators and a lot of the leaders in the world kind of were starting to get a feel that this was going to be significant, and really had to build a framework and maybe a way to control crypto. And so the way they were building that framework was very similar to traditional finance, but obviously very new to the people in crypto. So I thought, there would be a great opportunity to kind of bridge the two, have the TradFi experience, and jump into a world where, again, it was very much the Wild Wild West. I first
Yeah,
got there.
yeah, absolutely. So let me just frame this discussion up. So what I want to do today is because you really do have such an extensive macro background in so many different dimensions, and despite your very young looks, you you are a very seasoned veteran and a long history in macro as well. And so for the purposes of this discussion today, I want to tap more into the macro side to get your views and talk about things like the Bank of Japan, Japan assets, Japan markets, Japan investors, and then foreign investors into Japan, and the impact that all that has on global macro and global markets kind of as a whole. And then separately from that, if you'll of course allow me to have you back on, and then we can do a dive into just strictly kind of crypto and all that. But that said, I do have to ask you, because we are, let's see, year to date, we're about up 80% on Bitcoin. Quite a rally, and this is happening. Who knows why this is happening is what I want to know. What I want to ask you too. But a lot of the narrative is that this is basically you're seeing a lot of these bank failures happening in the United States. So this is basically a response to that or a hedge to that, I suppose. You're getting a lot of renewed interest. But what do you make of the year-to-date price action that's up, almost double?
Yep. So, in a nutshell, I think it's obviously there's a lack of liquidity, and so the volumes I think have been relatively low. But having said that, if you simplify it to supply demand, really there's a lack of supply after a lot of selling as we broke through 15,000 and really had that last sell off, and it just was stabilizing and it was kind of there. And what I think was the catalyst was I think China's stance on crypto and Hong Kong really shifted, and I think is that as soon as that started to happen, it didn't. It takes a bit of demand in a low supply market to kind of push it up and push it up aggressively. So as it broke through 16,000 and change, it really started to accelerate. Then it went through 18.5 and had another level of acceleration. So initially, I think there was a fair amount of technicals combined with there was a short pullback that was more macro related than anything. But from there, it just has gone straight up to 30,000. So effectively, it's roughly doubled from the lows of where the consolidation came from. So, I do think it's more the China story than the macro concerns or the bank issues in the US. Um, because you do need, despite all these stories on crypto and Bitcoin, which have been around for a while, the only thing that's really changed to me really is the new demand from what I think is Chinese money through Hong Kong.
Okay, yeah, because that's what I wanted to ask you was who is behind the move? And so, given your recent role and visibility, is it retail? Is it? I mean, are there still institutions? Is it a mixture of both? Like you said, is it coming from regionally? It seems perhaps Asia driven. But what did you see? I suppose from your role.
Sure. So if you first look at the biggest exchanges in the world where most of the volume trades, firstly, a lot of it's Asia. So some of the big firms, especially Binance, drive a lot of the volumes. At the same time, derivatives are a much bigger component than the spot markets. So derivatives probably account for anywhere between 60 to 80% of the volumes on any given day for Bitcoin. And Binance is massive. So their daily volumes were roughly, call it 100 excess on any given day. But they dominated the market. So I think a lot of it comes through Binance, which is accessible for a lot of people, including, I think, a lot of people in this region and all types of money from this region. The only argument potentially against this would be is that if you look at the increase in volumes within the 24-hour window with Bitcoin trading 24 hours, there is a bias towards the US market as institutions start to grow. But having said that, given the leverage that retail can employ through Binance and derivatives, which are not technically allowed for US investors, I would argue that it really was driven by derivatives, leverage, and the Asian trading community more so than definitely the US. I think the US has a hard time people accessing crypto. Europe is okay, but again, I think one of the bigger players, Bitstamp, I don't think they drive that much volume and they can't employ that much leverage. But in Asia, leverage can play a very big part. And as you know, in futures and derivatives, again, these markets can be much stronger drivers than the actual spot markets themselves.
Yeah, indeed. I actually noted on a recent episode of Market Depth, just this might have been the only kind of Bitcoin price action commentary I made so far, but I just wanted to point it out to people that the BITO ETF, the U.S. listed futures backed, was it ProShares Bitcoin ETF? That's again, it's futures backed. Their inflows in terms of ETF redemptions creations, their inflows have been rising because they hold and roll the front 2 months of CME Bitcoin contracts to the point where they're as much as half of the front month and more than like 3/4 of the second month. And so that might be the way that maybe retail or institutional in the U.S., as to your point, are getting at least directional exposure to Bitcoin. Agree with that at all? Or
I think the U.S. market and the market share of CME of the total trading volume is it's been growing, but it's still relatively light. Again, the sizes that are traded in Asia are massive. I mean, they're huge, and they kind of dwarf everything else. So it's kind of like looking at TradFi and saying that the buying and selling from any one hedge fund actually make a difference. When in reality, in Japan, anywhere from 70 to 90% of the volume is high frequency traders or quant trading. So again, what matters there is their trading. So similar, I think, in Bitcoin, especially in the Asia region, I do think leverage trading is a fairly significant determinant of price.
fair enough. And speaking of leverage trading, let's talk about let's talk about TradFi. So you and I actually kind of share a very similar story. So you grew up in the U.S., you moved to Tokyo, and you started at Goldman Tokyo. I also grew up in the U.S. I moved to Tokyo, and my first job in institutional finance was at Goldman Tokyo. You, however, you start off on the equity sales desk, if I have that correct, and then you move to the sort of macro trading and execution desk. Whereas I started off on the futures and options trading desk, and then moved to equity sales. Do I have that correct in terms of your kind of chronology and story?
Yeah, so I started looking after starting in the micro area, looking at single stocks, and really visiting a lot of Japanese companies with hedge funds. And so I had the good fortune of really spending a lot of time with some of the best, long, short, and generally equity managers who were doing fundamental analysis on companies. But from there, I moved to a more market-related role. So I was on the execution desk, and just to give my age away, I started when there were no algos yet. So again, we were just starting to build algos at the time and really replicating the thinking of our execution with algos. Um,
And what year was this, like, or what kind of decade time frame, I suppose?
so I started in the late '90s, and I joined the derivatives desk in about 2000.
Okay. So 2000. Okay. So, a solid, decade and a half before the Kuroda era.
Yes.
Okay. Let's talk about the Bank of Japan because, I mean, my goodness, what a, let's just call it fascinating and interesting central bank, an outlier central bank viewers of, and followers and listeners of the Market F podcast are very much aware of the Bank of Japan and its massive impact that it has on not just Japan, but on the global assets and global markets and global economy, really, for that matter, and fellow policymakers as well. Just so that people can hear it from somebody with much more credibility like yourself, can you just kind of explain the significance of the Bank of Japan?
Sure. I mean, you know, I guess the first thing that kind of really struck me was when they started to first buy equities. And I think obviously there was the example of Hong Kong, the HKMA, during the Asian crisis, which was a big one-off. But having said that, I think when Japan and the BOJ started to buy stocks, and I think I still remember when the announcement came out that no one really could believe what they were doing. But I believe this was 02, 03 when they were buying stocks and in meaningful size. And there's been multiple kind of versions of them buying stocks, but I think they're probably the first central bank to do this in such scale, magnitude, and persistency, and use it as a tool. So, it being an equity person and following the BOJ, that's the one that really stuck in my mind. And they were a leader. There were other banks and central banks, sovereign wealth funds, et cetera, who have kind of done similar things, but not in the same manner as the Bank of Japan.
Right. Directly purchasing equity ETFs is controversial at the very least, but certainly either way, groundbreaking in terms of modern, G5 central banks behavior in a kind of what should be a free market capitalist market. and a large liquid international market at that, for the central bank to step in directly, but kind of pales in comparison to the 500 trillion yen worth of JGBs that the Bank of Japan currently holds on its balance sheet, which is about over a little bit over half of JGBs of the Japanese government's debt outstanding, and is setting the price on the other half that is yet to acquire, in the policy of called yield curve control. And so the here and now, what's your take of the transition from Governor Kuroda to Governor Ueda, and then where do you see Governor Ueda taking it from here?
Yeah, I mean, talk about leaving him in a tough position. He's taken over in a very sort of uncertain world with a huge uncertain position, and really how to unwind or not unwind it. In the end, or at least initially, I think he'll take it very slow in terms of any sort of changes that's being made. I think Kuroda probably was a bit more maybe playful with the market and seemed to enjoy kind of surprises and kind of tweaks and so on that kind of threw people off guard and so on. I'm not sure that Ueda-san is going to that quickly be playful with the market and try different things. So I would think that any changes would be very gradual to start. And then from there, I think that it's a question of, is it inevitable that they have to unwind it, or are they going to just continue to try to reflate the debt away? And I'm in the latter camp.
Okay, so we'll get to that in a second, but just again for the near term. So the Bank of Japan is regarding yield curve control. Are they going to lift yield curve control bands higher, trading bands higher? Are they going to rip it off altogether, or are they going to maintain it? And personally, it's been my view that they might attempt to do that here and there, kind of like in December of 2022. Although I think that December 2022, what that taught BOJ was to not do that, and they kind of learned that lesson. But the reasons that people would say that yield curve control bands need to be at the very least expanded, if not thrown away altogether, is three basic reasons. One, Japan has inflation, so this policy is no longer appropriate. Japan inflation has a 3 handle, well above the 2% target inflation. So, again, this is no longer adequate or appropriate policy to maintain. That's reason number one. Reason number two being that Japan must get in line with the rest of the world. The rest of the world has tightened policy. Japan must get in line. And the third reason is that this is unsustainable. Those are like the three general kind of reasons for people to give. And then if you look at all those reasons, and unsustainable also means market pressure, with JGB's yields trading sometimes higher than yield curve control bands and all that kind of thing. And they're then buying an insane amount of JGBs on a daily basis, as they were in January of this year. If I look at each of those things, I'm now seeing CPI tick down a little bit in Japan. Core CPI not, but inflation does seem to be leveling off in Japan and potentially globally as well for the time being. So that pressure might be off. You don't have JGB yields trading above yield curve control bands necessarily. They are kind of hovering around there, but they're still staying within, and they're not conducting fixed rate operations on a daily basis and having to defend that upper band. So there's no real market pressure. You don't see dollar yen at 150 plus, so you don't really have the currency sort of pressure currently at the moment. So the market pressure is off. The get in line with the rest of the world thing, I always think is a very stupid argument, because Japan has never been in line with the rest of the world in terms of monetary policy. And then the unsustainable thing, that's a very subjective definition that's kind of randomly being thrown out there. It's not up to us to determine, to say whether something is sustainable or unsustainable. I'm just to be clear, I'm not saying that the printing money and buying financial assets thing can last forever. I don't think that that's sustainable forever. But this particular moment in time, I think, is a very arbitrary thing. So one by one, all the reasons for why they must make a change to yield curve control, those are all kind of out the window for the time being. However, I will note Deputy Governor Uchida, who is really the mastermind behind, policy architect, who's been around for maybe as long as you have in the macro world, but at the BOJ designing policy. He has said recently in Parliament that the nature of yield curve control is that you have to surprise and shock markets, because if you guide markets for it, foreign investors, whoever, are going to front run the hell out of it, and they're going to have to just deal with unlimited buying of JGBs again and again and again, going into whatever that policy is, and they don't have the option of setting the policy themselves. So by nature, when if and when the Bank of Japan has to make a yield curve control change, they have to do it by surprise. So I guess now that all of those reasons to change yield curve control are currently off the table, if anything, now would be the time to shock markets if they're going to do it that way. Markets can't be shocked by definition if they are already pressured and pre-positioned and being shorted ahead of time. What's your take on that? Do you agree with that a policy shock, if one were to come, would have to come by shock, and therefore, like times like now?
Yeah, no, I think the shocks that we've seen historically in Japan lead to sort of step function type trading that we've often seen. So it kind of does nothing and trades a long range for across asset classes, and then all of a sudden it just has these huge breaks. So Japan has historically, I think, done that, and that's the way to trade it. So I don't disagree with the shocking to do that. Having said that, like you mentioned, that with inflation kind of peaking out and coming back down, and some of the all the factors you named to cross off the list, I think that is short term. What may be a focus is that um, you know they won't move till they need to move, but once they've made that decision, then they'll kind of play with the timing, is what I think would happen. I don't think that they would try to be ahead of the curve. I think they'll continue to stay behind the curve, but the time of when they kind of get out is when you least expect it. So from that perspective, I do think that in the short term, you could surprise, but I'm not sure that they'd be willing to. But when we least expect it, later this year or early next year, would probably potentially be, especially if there's a long consolidation period. So I do find that when everyone's sleeping, by the time there's a consolidation, nothing's happening. The market's kind of falling asleep because it's boring. That's when they move, is the way I would kind of view it. And once the breaks happen, then I think the macro hedge fund community will come in and through various forms, including optionality, and really squeeze the markets and cause the moves to accelerate. And I think the regulators and the BOJ and everyone knows how these things work, and so they're very careful about first being sure that that's what they want to happen. And then once they're like, okay, well, we're ready for it, then I think they can do it. But I think the big problem here is currency. I think that the way they do it is in a way in which, again, you might surprise them when you're at the top end of the 128, 152 band of something that's a bit more hawkish, and vice versa.
Okay. You just mentioned something that you and we met up, we spoke at length, but you said something that really kind of opened my eyes to a view that I hadn't considered, and that I think is very profound. And so I want to ask you about the Widowmaker trade, which is foreigners specifically shorting the JGB market. It's called the Widowmaker trade. Look, the fact that trade, that term being a widowmaker, that could apply to any trade in any financial asset in any direction. Something that investors always lose on, and hence, their spouses are made widows. But that term is specifically reserved for shorting the JGB market. Why do especially foreigners continue to short the JGB market? Why do they keep taking shots at what is explicitly called and known as the Widowmaker trade? You will die if you do this trade. And my take was that there is a huge gap of just pure understanding of what the Bank of Japan is changing or not changing policy on, or being driven by in terms of policy, and what they are what the foreign community perceives. So if the foreign community thinks, oh, there's 3% CPI in Japan, they must do this now, like I just mentioned before, and therefore I'm going to short JGBs. And that lack of understanding, ARB really is something that you can just kind of that I've positioned with BOJ against those who would soon become widows, widowmakers. But you gave a completely different take on it that I hadn't considered, and that frankly I would say that I was wrong with my kind of thinking. So Taka, tell me why do foreign macro hedge funds continuously short the JGB market? Why do they bet against the Bank of Japan?
So there's probably some trades out there that can't afford to miss, and this is I think one of the biggest trades out there in macro across the globe, that across all assets, that most macro people who've been around for a while just can't afford to miss. And this is just psychologically, whether they're at a dinner party, a macro event, or so on. If it were to ever happen, and you're a macro person and you're not in the trade in some form, and it doesn't cost much. There are cheaper ways of putting on the trade. Again, looking at an asymmetry, a risk reward of 5-to-1, 10-to-1 on some CMS caps or some sort of structure. But just being involved, I think, is going to be major dinner conversation if this event were to, of course, ever happen. But even if it were to become close, so there's that part of it where it's just people willing to throw a little bit of money at it to be involved, and and it's one of the biggest trades if it were to ever happen for anybody.
Yeah. So when you said that to me, I was just like, "Oh my God!" Like you're 100% right. Like I never thought about it this way, because I was thinking like, what don't these people understand that when let's talk about the Kuroda era, right? Because Ueda is just one meeting and he's brand new. But when Governor Kuroda says we will maintain policy, we are bid for unlimited, we will run you over. Don't mess with the Bank of Japan. It's called the Widowmaker Trade for a reason. And when you said that, like, just I was a light bulb went off. Like, that's exactly why they have to do this. So we're talking about like the biggest macro funds that have, even like the Soroses that have like the Bank of England trade under their belt and all that. But the one trade that they cannot, that they haven't, succeeded with yet, and if that were to happen, and you're not involved, that is more of a risk than actually putting that trade on. In other words, it's not about the money at this point for them, but it's about the reputation and it's about the personal pride. It's not even ego; it's just it's personal, stature, I suppose. And there's that angle, right? Is that's what I was missing? Do I have that correct?
Yeah, no, I think so. But I would add one thing is that I think the currency trade will become a part of the same trade. And I do think that where they'll look to actually make money is in the currency. So if dollar yen breaks to 152, then I think everyone would be jumping on that train and trying to make money there, but probably having something in their back pocket on the rate side as well. Again, it's a low probability thing, and I think it's probably clear that the central bank will sacrifice the currency before the bond market. But again, there'll be one in the same trades, but how they look at them is slightly different.
Yeah, and I've actually said that before too. That especially after September and October of 2022 of last year, when the Ministry of Finance came in and blasted dollar yen down 5 handles in like 20 minutes with unilateral interventions, which by the way, I think it was October 22nd, 2022. At around 10:30 a.m. Eastern time is when they did it. That was bottom tick in U.S. 10-year U.S. Treasuries. In other words, that was top tick in 10-year U.S. Treasury yields and top tick in USD JPY as well. And that was done. That was the Ministry of Finance in Japan putting a V bottom point into the U.S. Treasury market. But just back to like this notion of these macro funds and these traders who insist on shorting JGBs or just betting against the Bank of Japan, that they'll blink somehow. Just like you said, like it's the risk isn't. They know what the risk is from a P&L standpoint. They're fund managers. They know what that is. But the other risk, the reputational risk, the can they live with themselves sort of risk, that really is what looms, right? And as you said, like, you need to. It's almost like a point of pride to have gotten war scars from being run over by the Bank of Japan. Like, yeah, I've become widowed before, right? And if you don't have grass stains on your uniform, you haven't been in the game. You're not a real player in the macro. If you haven't been blown up by the BOJ, you're not a real macro hedge fund or trader. And so that's almost kind of point of pride almost, right? Would you say that that's the, because, and I ask you this because you're the one who actually was sitting on the desk, during hearing voice trading happening on trading floors, and you're watching these fund managers and how they execute, and you have a really deep understanding, personal understanding of how they operate and what the people behind them and what's, their personalities are. And so would you say that's kind of an accurate way of looking at it? Or am I painting too broad a brush here, or stereotyping too much, or?
I'd maybe add one nuance to it is just if you look by decade. And so I think when I started in the 1990s, there was a very strong desire by many of the biggest hedge funds, I think, to put on that trade, and in the 2000s and then the 2010s. And it's kind of evolved over time. And there's different ways of putting it on, but and the players have changed slightly. But many of the players who were doing it in the first two decades I mentioned are still around or have the ability to do it through some form. So
Family office or whatever it is.
correct. And so although they may not have the same firepower, maybe relative to the overall pie as maybe they used to. But I think they'd still look to try to get involved in some way.
Yeah, they wouldn't be able to live with themselves, especially if they tried it before and then they missed it. Yeah. So then when you told me that, I started thinking about that a lot, and then I was thinking like, all right, so there might be actually an opportunity in which almost not every single, but like almost every BOJ meeting, there's going to be some speculation that the BOJ is going to crack, and the more every time it doesn't, you could actually just trade alongside the BOJ. So you could just be short dollar yen, or I'm sorry, long dollar yen, short the yen into these, and then kind of cover on the short squeeze out from these funds each time, until the one time that those funds are right. But yeah, this is a very, very interesting way to think about it. You totally open my eyes of a whole new kind of way, approach of the foreign capital. Let me ask you about like just Japanese capital and foreign capital in general. Let's first talk about Japanese capital, I suppose. So I've been flagging to market depth followers basically this entire time that this podcast is happening that the reason that you need to watch Japanese institutions and Japanese capital has nothing to do with my geographic location. Like, there's no bias here. It's because Japanese capital is the largest that's being deployed overseas, right? Japan has the largest net international investment position. It owns the most foreign assets. It's the largest foreign creditor to the United States, as well as, in Europe, in Australia, because Japan is cash rich, yield starved, and yield curve control and policies like that, the low rate environment is pushing capital overseas to find some sort of yield, be it in the safest of U.S. Treasuries, hedged or unhedged, to like very shady CLOs and anything and everything in between, right? But can you just kind of touch on like the significance of the sheer scale and impact, global market impact that Japanese institutions as a whole kind of hold? Banks, institutions, GPIF, insurance companies, so on and so forth.
Yep. So, I think a lot of people start, April and look at the new fiscal year plan for many of these guys and see how their sort of asset allocation is going to be and where it's going to go. Like you said, the sheer magnitude and size of their flows are significant, but they've been investing overseas for a long time, and and view and have a good grasp of yield and carry and some of the other issues. But I also think that they're also some of them can avoid some of the big problems we've seen too. So in any trade where they need to, even if they're investing overseas, fund short and lend long effectively, and what is but if you have an inverted curve with a negative carry, I think that they were early in probably avoiding some of the trades, which have blown up, some of the regional banks in the U.S., for example. So I think a combination of magnitude and experience over the years, I do think make them important investors to consider in terms of the implications across the globe. Obviously, in fixed income and credit, I think they've historically been very big. And when they're pulling out, it's a tide that's going out, and when they're going in, it's the other way around. And so there's some long-term trends that are created by them. And I start with the most basic is back in 99 2000 when all the postal savings were starting to mature and the yields were going from extremely high to close to zero. There was a major shift of capital moving overseas and beginning the carry trade. So, there's a pretty long history of this type of global asset allocation and search for yield that has probably been that the Japanese are probably one of the best at doing. So that's something I think will continue to be the case as they shift capital overseas. But I do think the higher rate environment in the new, arguably, regime we're in may change the way they invest. And so it'll be interesting from here as to if their behavior really starts to structurally change.
Yeah, that's what I want to ask you. So, what is your view? I guess. I mean, I think that you mentioned that you spoke to a mutual acquaintance of ours who was a JGB trader. Are they going to repatriate back home to Japan now that Japan may have higher nominal yields in JGBs, or will they continue to deploy capital overseas? What are you hearing, and what do you think in terms of a bigger trend? This is a trend shift.
Yeah. So. I think that the expectation for sort of the local market is that it's not going to blow up. And so again, where there's greater risk maybe in other parts of the world, Japan,
where what's not going to blow up the JGB
Japanese
market's not
market,
going to
yes,
blow up.
yes.
Yeah. Okay. Yep.
So, again, in terms of financial crisis or, markets and blowing up and having massive dislocations, yes, you still have them in Japanese markets. But I think I guess the surprises are going to be bigger potentially in other markets. Obviously, we're seeing it in the U.S. fixed income markets where volatility is extremely high, and you've got these gaping moves that, in that market. But, in other markets, it's going to be significant. So I think their appetite to really go out the risk curve will take some time to recover in markets outside of the most liquid and quote unquote safest. So the conservatism will continue to be there. And from that perspective, Japan or the local market seems to be one that is relatively comfortable. And so with that money continuing to support the local markets, any major, I think, move in Japan might take a bit more time.
Okay, and then what about Japan retail? Because I think that a lot of people seem to underestimate or not even realize, again, the impact that Japan retail has on global markets. Again, due to the sheer firepower size, right? Over half of household assets in Japan are in cash. And so there's a significant amount of firepower. What's your view on, I guess, Japan retail trends, investing trends?
So, I think Japanese retail trends are probably in two buckets. One is very conservative and one is very risk taking. So, as we've seen in,
Is it generational,
no,
that divide?
I don't think so at all. I mean, even sitting in crypto, you see those same trends. Is you see some very conservative and some very aggressive, and it's irrespective of age. So, as an example, I think that the investor age brackets, I think, are centered around something close to, I think, 20 and 70. You know, but just because they're at the top end of that range does not mean they're all conservative. And so some of these
They
people
were they were the '80s bubble people.
yes. So they
Yeah.
can take some significant risk from what I've seen in crypto as well. So I think the same applies across assets. So would they look at Turkish lira, or would they look at binary options or all sorts of things? Yeah, I mean, and it's really that the individual's sort of risk tolerance as opposed to age, which is sort of an interesting, I guess, dynamic that may not exist in many other parts of the world to this extent.
What drives that
So
risk tolerance?
go ahead.
Is it speculative, sort of animal spirits, or is it kind of out of need almost, or is it out of, I don't want to sound too, grim, but like hopelessness, and therefore why the hell not, sort of,
YOLOing?
YOLOing. Yeah, I was trying to avoid that, but yeah, YOLOing or whatever it may be they 70 years old, blowing up the Bitcoin bubble in 2017 out of Japan, the going long TRY JPY as it's melting down and things like that. What drives that?
Yeah, so my wild guess, I think, is maybe twofold. One is true with many people. It's what your earliest experiences teach you. So if you started off with a good experience where you made some money in something, you tend to kind of relive that experience and take a bit more risk, and vice versa. So I think that's this one. I think the nature of some, and again, these are all unfortunately kind of human nature, kind of softer things, but some people have a bit more of a gambling streak to them, if you will. And so, products that cater to that are being devised pretty constantly, knowing that there's that type of people who are ready um, to use products where they roll exposure and so on, and to continue place bets. And then there's the more conservative who are looking for yield, and again, who have found a strategy that they get comfortable with, whether it's a buy right strategy or any sort of yield strategy, and they just continue to kind of do it, and they're very patient. And what you see that, for example, in crypto, is that the biggest flows tend to be mean reversion flows. So when the markets are crashing, they'll come in and keep buying in Japan, and vice versa. When the market's rallying and everyone's getting exciting, they'll just calmly take profits. So, which has been a fairly a good strategy in many volatile assets that have a trend, which again, crypto has had big up cycles and down cycles, and so on. But I do think that the longer term patient crowd, who can sometimes move large chunks of capital, can become bigger players in crypto as well as in traditional
Yeah,
finance
definitely.
markets.
There's something that I noticed a few years ago, was that, so Monix Group, who, it's like a Fidelity or like a TD Ameritrade. It's a trading platform. It's a retail, online brokerage platform in Japan. And they put out a survey every year of their clients, of their retail customers in Japan. They have presence in the U.S. They own TradeStation. They have presence in Hong Kong and in Australia, I believe. And they do a survey of their retail, customers, and it's always interesting to see like what their views are. Japan investors are always not bullish on Japan, and are always bullish on the U.S. U.S. can sometimes be the exact opposite and all that. But the one thing that I did notice was that they, at the end, they kind of list the demographic breakdown, the age groups and all that, especially. And it's funny to see that, like, you'll see the age group of like 50 to 70 or 60 to 70 years old, and or those with like 1 million USD in assets and above. So the older, richer people, those consist of, like, that's one of the biggest groups. And then there's a valley of like nothingness in like the people in their 50s or 40s. And then once you get into like the kind of 20s and 30s, it starts to pick back up again. And that's something that kind of developed sort of recently. And what the way that the timing works is that 2013 Abenomics did not get the younger generation, the millennials of Japan, and the younger, interested at all whatsoever in investing in financial assets and green and red blinking tickers, period. But just around when the 2017 crypto or the Bitcoin boom happened, that was largely driven out of Japan, that 2017 one, that's when you saw them coming into traditional TradFi markets. And so it's, to your point, a lot of them made their money. A lot of them definitely got blown up, in that spectacular collapse as well in 2018 for Bitcoin. But that introduced them to this world of markets, and they're looking at it through a lens of things go up really sharply, and that's how they're almost conditioned and born into it, and has reinvigorated almost or invigorated an entirely new generation here in Japan.
Yeah, no, I think I think it's very case by case and person by person. Again, as opposed to sort of generational. And some people got involved and made some money. So, for example, even in this cycle of crypto, there are people who probably made a lot of money in things like Cardano as opposed to Bitcoin, and enormous amounts of wealth that's created, for example. And then being able to get out as well, so not being overly greedy. So I think those things definitely benefit, and the notion of not being overly greedy, I think, has definitely helped others to accumulate and then to go in again. For Japanese equities, where again there's been this long-term sort of stigma that's been attached to the market of that, it's still a bit of a gambling casino kind of thing. That stigma, usually they say the investor's mind, kind of it takes 25 years for it to kind of reset, for people to forget. And we've well past that for the Nikkei. So you'd think that hopefully people have gotten past that. But I do think we will see that point in time where, again, everyone that touches the market won't have, most of them won't be scarred by the '89 bubble. And from there, again, as a form of building wealth, they just need to find growth. And to your earlier point, that Japanese have a bias towards the U.S. equities. I think it's they have a bias towards growth, and they want to see when they're investing in stocks something that is backed by growth and some. So if again the Japanese economy can recover through hopefully some with a weaker yen and greater exports, as well as the inbound. I think this could be very powerful
Inbound
to
tourism, you mean?
tourism, correct?
Yep.
And I think that could be powerful to spur interest in growth stocks and growth related equities and growing earnings in this country. So that's a highly kind of contrarian view at this point still, but I think it could be one of the most interesting.
Yeah. I don't know if it's that contrarian. So let's talk about foreign capital now. So as you know, Buffett's son, Warren Buffett, he was in Tokyo. He is long the five Japan trading houses. And as I say, that he put so when he initially got into this was at the August 2020, he basically put on a phenomenal macro trade in which he borrowed in Japanese yen. He issued Berkshire Hathaway issued bonds to fund these long equity positions in the five trading houses. The trading houses, by the way, are around 1,000 subsidiaries each. It's very, very difficult, almost impossible to do bottom-up fundamental analysis. So it makes it a very weird Warren Buffett trade or investment, if you will, because he's not single stock picking, and indeed he's not single stock picking because he went equal weight across the board. Five trading houses, 5% allocation each, and those stocks basically move. They're commodity plays. They move up and down with commodity markets. So basically, what you got was Warren Buffett in 2020, at the end of 2020, put on a phenomenal macro trade in which he went short bonds, long commodities before interest rates and commodities skyrocketed. And then he came to Tokyo recently, I guess, to just to pat management on the back, and say what a good job that they're doing, and to disclose like a larger stake. But what's your view on foreign capital, on Warren Buffett, on foreign capital, seemingly renewed interest in Japan equities from the international community, the Nikkei outperforming the major other regions year to date? You see the largest foreign inflows, weekly inflows on record, or in maybe in 30-year highs since that Warren Buffett visit to Tokyo and his step of endorsement of Japan equities. Is the foreign capital going to get back into Japan now? And now of all times, when they also simultaneously happen to think that the Bank of Japan might royal markets and raise rates?
Yeah, no. So Although probably most of us will never know, the true purpose of his visit. But if there is more to the visit than just patting the backs of some CEOs and the management team of the trading companies, it could be a very significant sort of catalyst that we look back upon and say that was maybe the start. As you know, the Nikkei has kind of rallied to about 30,000. It's just been capped there. But as the longer the consolidation, the bigger the breaks when they do happen. We'll kind of look back and say, hey, maybe that was, a key catalyst to get the foreigners to really wake up to the fact that even Warren Buffett is perhaps looking beyond just a 5 set of stocks and a wider range of potential targets and seeing the value and then the unlocking of that value, which hasn't happened in many ways for a while, as many have called Japan a value trap. But when it's again unleashed, if it's going to be a big trade for many people, whether it's just general equity people or your macro team, your macro as well.
Yeah, definitely. And it's not just Berkshire and Warren Buffett, although he is obviously the symbol of buy and hold long term. But recently we had reports of Citadel coming back into Tokyo. They left after 2008. They basically sat out all of Abenomics. They're coming in now of all times. You have Point 72 who's stepping up, who's increasing their Tokyo presence. Steve Cohen saying Japan has, extremely wonderful value and all of that. Again, now of all times, you have Blackstone coming in, a lot of like private equity deals. You have like a lot of activity happening in Japan from the foreign investment community. And I'm wondering why and why now. And the only sort of glue that could tie this all together is that they share a view. Something is change. Something is going to change in terms of monetary policy or otherwise. But there's a changing tide. The Japan kind of economic mechanics of and markets for which they want to be positioned in. But what do you make of all of the? Are they all just doing these separately, independently of one another, or what's behind all this?
People tend to follow big trends. So the Nikkei has historically had these big breakouts, whether you look at 2003, 2005, so what is it? July of '03, August of '05, November 2012, etc. And you've had these breaks, and then post that, there's a lot of kind of looking back and making up well, I won't say making up a story, but there's a lot of triggers that had the market not broken out, may not have been as big a story potentially. The one thing I just say about the equity market that I've always focused on is in all the rallies between '03 and the ones I just mentioned, the one sort of thing that kind of signaled the breakout is the Nikkei volatility curve. And so it's one of the few markets in the world where I think this occurs is that before the break, the volatility, implied volatility of the options on the calls tends to spike in the short dated, and it tends to invert. So you have this, what usually happens in a market crash is the volatility at the short end spikes and the longer end is more stable. But in Nikkei, it tends to do that before the breakouts and during a breakout. And so it's one of the rare times that this market crash occurs on the upside as opposed to the downside. So again, if we were to see the market continue to test this 30,000 level, and you have some level of stability in many of the macro factors out there, I would kind of look for that to occur and signal potential sort of major breakout. So we'll see. But I think that that's something to keep an eye on.
I love how you put that. The market crashes to the upside. Because this is Japan, and obviously it has to be different and weird in every way. But yeah, no, you're totally right though. That spot up, vol up phenomenon. That this is actually going to be a substantial move when you see that like vol phenomenon taking place. But it is a very strange thing to happen. It's basically like S&P rallying alongside the VIX. You mentioned long short funds, and the reason that really struck a chord with me too is because I also mentioned this on a previous episode of Market Depth. But when I'm looking at all these players coming into Japan from foreign, right, and the glue just might be that they have a view that monetary policy is changing and there's going to be a entirely new regime that somehow benefits them, whether it's Citadel and like, I don't know if it's Citadel Securities or the hedge fund arm, whatever, but either way, they benefit off of market activity and volatility. Long short levered funds like 0.72, they would benefit because QE, what that does is it papers over everything, all the fundamentals, everything. They kind of looks the same, but once you remove that blanket, right, as Warren Buffett says, like once the tide goes out, then you could actually exploit differences in fundamental long short. This is a crappy company. This is a growing company, and markets realize the long short. If Steve Cohen has a view that QE is about to be lifted away from Japan, that's going to help his long short opportunities.
The one thing about long short I find also in Japan is, they're very good, consistent money makers because I think they also have a good grasp of the trading regime. So in a market that's trading sideways, where again, long short, shorting expensive, buying cheap, or whatever sort of strategy you might employ or some version of that is fine until you get to these major breakouts or crashes. And so during those periods, I think a lot of those strategies can suffer or else they need to be hedged. And so I think the experienced managers in this market tend to be able to differentiate between those regimes and also be able to and handle themselves in those periods, in both sort of periods. And which is a bit different than I think other parts of Asia where, again, they tend to either ride a bull market or they tend to be steady, but they haven't had this kind of shift between the two, perhaps as much as Japan has had to in the past, 3 decades.
Sure. Yeah, absolutely. And this is not trading advice, obviously, ever, but if somebody outside of Japan wanted to get Japan exposure, I mean, would they just be able to do so via Japan equity ETF, something like that? I think DXJ is the currency hedged one. EWJ is just the straight up iShares, MSCI Japan fund. And they obviously have huge differences, divergence in performance over the last year with the yen crashing like 30%. But
yeah, no, I think the currency is unfortunately going to play a big part. So, the unfortunate thing would be is that you get some stocks that are very good and stable and growing in Japan, but with any depreciation in the currency, again, it'll eat away at your gains. So as you mentioned, the currency hedged ETF is one way to look at it. I'm not sure that I would expect the yen to go crashing, especially in a market which eventually sees, or an economy that sees a recovery. So if Japan again, a weak yen might help initially, but then we could see a decent amount of capital inflows to more than offset that. So from that perspective, owning Japanese stocks might not be a bad thing as well. And really, there's probably two major buckets is really looking at exporters and a lot of good solid tech companies, a lot of good component companies that have global market share on one hand, and then you have a lot of sort of domestic companies, I think, that could benefit from any recovery in the local economy driven by both nominal growth via inflation, as well as the inbound tourism trends, which are, again, big enough to help offset some of the demographic consumption declines. So, those two buckets I think are quite interesting. My personal preference is the latter, because I think it'd be a bit of a positive surprise. And there are a lot of charts that I look at which do seem like they're on the verge of breaking out. And so I do think that, again, once the overall markets kind of go through 30,000, if they do, then it might make it interesting with some of these stocks which have really started to move, but could potentially see some acceleration.
The differential in performance from 2022 of DXJ versus SPY and EWJ. DXJ is a currency hedged ETF. EWJ is the not currency hedged ETF. And so the S&P 500 and EWJ have moved kind of more or less percent in tandem downwards. And since the beginning of 2022, they're both down about 11-12%, and been down as much as like 25% or so towards the bottom of last year. Whereas DXJ, currency hedged ETF, is since then has never really been negative, and it's up 15% currently as we speak. So that's That's a DM index that is up 15% throughout 2022. Like you said, you do have to be really careful of the currency. That's going to be the major distinct difference between whether or not you have positive or negative P&L with your Japan holdings. But yeah, if you have currency moving in your favor from a foreign perspective, as well as the assets moving up through 30,000 and beyond, yeah, it could be really significant. I think in terms of opportunity for portfolio exposure that does not have like a banking crisis attached to it. You've had an amazing career so far, global macro, not just in Japan, and then obviously with being head of sales and trading in Bitflyer. And so, what's next for the great Taka Kato? Like,
Now, um, I am looking at maybe two areas really, and one is one is trying to help the younger generation here in Japan really with investing. There's never been a strong investing culture here, and so there's been many attempts at trying to educate. But that's something which I would love to try to imbue some sort of global, international kind of investing and macroeconomic sort of thinking into the next generation here, and really save them from what is potentially a economic cliff that the country faces probably beyond 2030, 2035-ish. And so, I think really the people of this country need to become much more financially literate before then, and especially at the younger generation who are going to see some heavy headwinds against them. So that's one.
I think
And
that
then,
rings true for globally too, not just Japan. You know, but
yeah.
yeah. Okay,
Um,
so that's cool. So I'm definitely behind that. I definitely agree with you on the lack of education part or the financial literacy. And I don't know why they don't teach this in high school, like as a mandatory course and stuff like that. Personal finance. But
yeah.
I definitely think that's a noble cause.
And I guess the other thing is just given my experience in the last couple of years with crypto is really looking at various projects in Web3 and NFT space, which again I've been very skeptical of crypto in the last 2 years and I really didn't focus on it on the long term potential until this year. So at the end of last year, I really started to shift my thinking on crypto in crypto assets, not necessarily as currencies. And I do see some interesting use cases which I couldn't see before. I'm definitely looking at a lot of projects which are real solutions to real problems that actually need to be addressed because many of the projects I have seen are really solutions to kind of small problems and maybe not urgent problems or really almost irrelevant problems. They might not be a solution to anything, but just for the sake of launching. So I finally I think there are some things that are quite interesting in terms of projects, and I'm looking to get involved in some of those.
Okay, well, to the extent that you can or cannot talk about that, I would love to get you back on just to talk. What I want to do is definitely get you back on to talk strictly about crypto for our separate discussion. But Taka, I really appreciate your time and all your wisdom here. So where can people find you and follow you if they want to, I guess keep up to see what you're up to and potentially get in touch and all that.
So I'm on Twitter. At MMT Global. Given that I started Twitter right before sort of MMT became very big, I did think it was going to be, something insane that moves the world, and little did I know. Yeah, mainly on Twitter.
Wonderful. Well, Taga, this has been wonderful. Thanks so much for all your time, for your wisdom. Do you have any last words for the viewers of Market Depth as our inaugural guest, for which you've stamped in history and planted the flag? Very, very grateful for. But yeah, any last words of wisdom?
Well, I mean, Weston, I think it's great that you're doing this as sort of a gateway into Asia for many people from overseas, which I think we both did when we're at investment banks. But again, I think people have a hard time from other parts of the world outside of Asia really following Asia. And so having something like this that they can kind of wake up to is critical, and I've seen the need for that over a couple of decades. So, and I can't imagine this. I think it might be as relevant, if not more, in the next couple of decades as well, especially in all asset classes.
Well, that's the best endorsement I've ever heard. So, very excited to see what you have up your sleeve coming up. But thank you, sir.